in many places is that Riskometer, where they show you like how risky your investments are. I have actually found them, unfortunately, again, not to be super useful. I mean, I know they have a purpose and then they have a methodology. But in my life, I'm like, when things have to go wrong, your ultra short term fund will not be able to return your money to you. Your index fund will have some stock that is suddenly no longer trading and you won't be able to get money out of it. So I've become very skeptical of the Riskometer. So trying to be provocative here, but should I just ignore them? Or is there a place where the two of you have actually found it to be helpful? Uh, Rather than just be this legalese or just something you have to do. Maybe Vashisht first.
It brings some standardization so that if otherwise in this absence, if you were to tell AMCs to describe some kind of a risk measure for each scheme that they have, what would they do? So everyone can come up with their own measure of things. Now we have more. It's not just Riskometer. We have to disclose, I think, information ratio and Sortino ratio and Sharpe ratio and whatnot. But they're all, make sense in certain contexts. Riskometer is a more like a visual indicator of you see it immediately, you know whether it's a risky vehicle or not. In that sense, it makes more sense when you're comparing schemes within the same category. So if you look at equity, almost all of them will be high risk or very high risk, whatever is the highest. But say you're looking at hybrid schemes, some of them may be moderate, some of them may be high risk. So then you will notice that, why is this difference? And then you'll see, some of them are more conservative in the things that they pick. Some of them may not be as conservative. They may be more aggressive within the same category itself. So that's where one use case for the Riskometer. Also, Riskometer tells you the Riskometer of the benchmark they are using. So when you're comparing the two, the scheme's risk category should be the same as benchmark. If it's higher than the benchmark, then you have to ask why. If it's lower than the benchmark, also you should be curious why is that.
Deepak, do you like the Riskometer?
It's an interesting tool for debt funds, because I think that in a debt fund, the idea of risk, for instance, if you saw a liquid fund, you would think of it as saying, it should have the lowest risk possible.
Sure.
But there are some funds which don't have the lowest risk. So in certain cases where they take on a certain layer of credit risk by buying into bonds that mature within 91 days but are issued by a company that does not have the highest credit rating possible, you end up with a fund which goes into a different risk class, and therefore the Riskometer may show a difference. This immediately strikes you because you're looking, wait, I thought I invested in this fund for the lowest risk, and look, they have a higher risk. The same thing applies in a lot of hybrid funds as well, where you might say, some funds have a higher risk versus low risk, because in debt, the Riskometer is an algorithmic parameter. It's not determined by the fund manager. It's not like, I want this level of risk, that's why I'm going to do this. Whereas in equity, you almost always take the highest risk class available because you know that equities are going to be risky and volatile. But here's the interesting thing. I feel over here one of the problems of the Riskometer definitions is that because it's algorithmic, sometimes you will switch between one risk area and another risk area just because, when I say it's algorithmic, it's like this. You got a bunch of investments. Some of them are government securities, some of them are corporate bonds, some of them are lesser rated corporate bonds, and so on. So now when you have a combination of this, today it may correspond to one particular area saying, it's moderate risk. But tomorrow, because of credit rating of one of your bonds has fallen, you could automatically switch into the higher risk class without the fund manager having done anything about it. So the fund manager will have to now actively take action and say, I want to reduce this bond as a proportion of my portfolio so that I remain in the same risk element of my risk matrix to be able to kind of use the Riskometer appropriately. But in general, in equity, Riskometer is usually volatility-o-meter actually, because it just simply doesn't tell you that. So in effect, if I'm looking at a 5-year or 10-year horizon, equities have been actually very low risk. In the sense that
famous buzzwords, but okay,
yes,
yeah.
in the sense that we've never had a long 10-year period where returns have been negative. We've very rarely, if ever, we have. So the risk is basically the chance of your permanently losing capital. If on a 10 years your chances of permanently losing capital are taken in equities, even equity funds, I think there will be a very, very, very small percentage of funds. But can you say that on a 1-year basis, my volatility, which is up and down, that I would face, is going to be high? The answer is yes. So that's why you choose the highest risk possible in an equity fund, simply because the volatility is very high. Whereas in debt, there is chance of permanent losing capital, simply because bonds are illiquid and they have the chance of defaulting, where you will lose permanently a lot of capital, and there's no easy way to make it back. In equities, if I have 5 stocks, 2 of them can go up 300%, well, 3 of them can go to zero. So even though I've lost capital in 3 stocks, I've made up capital in 2 or 3 others. In debt, when it goes up, you get 8% to 10% to 12%. But when you lose 100%. So there is a disproportionate loss. So in that sense, the riskometer actually makes a lot more sense for a debt fund than it does for an equity fund, where equity fund, it behaves more closely to a volatility meter than a riskometer itself.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully. Past performance may or may not be sustained in future and is not a guarantee of any future returns.